Okay, very good morning. It is Wednesday, the 21st of March. I hope everyone is well. Quick overview then. I'm going to talk over just how the charts are set up this morning, just very briefly, because I want to get into the news quite quickly. A few things to obviously cover off. Some of the movement, particularly in the tech space, as Facebook shares continue to remain under pressure recently. We'll have a look at why oil was rallying yesterday, and then we'll of course talk a little bit about the FOMC, which is coming out later this evening. I'll hand you then over to Sam, and he can look at the charts from a technical perspective. So just going straight into it, looking at the charts this morning, you can see we've got a little bit of a theme of dollar weakness. We're down about 1/3 of 1% in the dollar index at present, so both major pairs have managed to get above pivot at the moment, and in the case of cable, we're already in sight again of that 141 handle, and R1 sitting just above there at 06. Looking at the kind of peak of the rally which we had back at the beginning of the week, and obviously the agreement in principle of a transitional deal looking to be finalised, of course, at the end of the week when they have the EU summit coming on Thursday and Friday. So upside levels, again, we're not too far from where we were on that initial response to the positive developments that took place at the beginning of the week. But in terms of the way to play that going forward, again, I'll leave that to Sam. Equities are pretty flat this morning. We did have a marginally positive close on Wall Street last night. I would say the equity setup this morning is a little bit reflective of the fact that there's a big event, of course, happening in a couple of hours' time, and so I wouldn't be expecting too much commitment to outright large moves until that point of the FOMC, which of course will be 6 p.m. London time later on this evening. But let's just have a quick look, and a few questions I want to ask you guys, and so if you be at the ready in the chat room. This is the heat map of the S&P yesterday. And as you can see, Facebook shares were down another 2.5% as they continue to be involved in this kind of latest scandal about their data and the regulatory effect that might have now for some of the social media names. But Facebook's lost approximately $60 billion in market cap over the kind of period of 48 hours as this story has emerged. But as you can see here, the most green company right in the middle, Amazon, up another 2.7%. Now, yesterday, Amazon overtook Alphabet and is now the second largest company, more most valuable company in the world. Can anyone tell me the percentage gain of Amazon over the last year? Let's have your answers in the chat room, please. How much do you think has Amazon shares by percent gone up from this time last year? No checking online for Amazon shares, please. Just go for it. Okay, first number on the board, I've got 68. I got an offer at 90. Anyone else? Stanley's gone for 80. Okay, getting a calls for 100. Got a spread of 35 to 100. The answer is 85%. So Amazon shares in the last year have risen 85%. That is equal to $350 billion, which, at a guess, I would say probably is about 490 of the 500 or so companies in the S&P, just in the size of which they've grown in the last 12 months. So pretty incredible when you think about that company. But Amazon continues to push on, again now second biggest company on the planet. So interesting stats I thought I'd just point out. Facebook shares, though, as I said, have come off considerably with this movement that we've had in the last 2 days. But this is just a reflection of Facebook's stock price since 2016. Now, it's got a few points of interest here where the stock price has seen a momentary dip. But you can see that every dip that Facebook shares have had in the last kind of 2 or 3 years when there's been negative news has only offered investors at this point a better opportunity to get in and get long again. You can see back in the summer of 2016, this is when Facebook said it was running out of room to show adverts. Shares dipped back to levels not seen since the beginning of that year, only to then rally quite aggressively. You've had Special Counsel Mueller in the US looking at the Russians' infiltration of Facebook, shares dipped and then rallied aggressively again. And we've seen the biggest dips so far. The interesting question here is we're now back to levels that were seen, I guess this would have been August, September of 2017. Is this a point of when we're going to see a little bit of history repeating itself or not? Is yet to be seen. But quite interesting just seeing some of the tech moves. And from a behavioral point of view, what was quite interesting is that the US equity market actually finished up yesterday, whereas obviously it sold off a significant amount the day before. And I was explaining to some of the guys here on the trading floor about how what happened on Monday was that the Facebook news was the catalyst, but then you get the short-term intraday speculators also hitting the market short. This then sees the volume pick up, then the algos get involved, and it almost becomes self-fulfilling. The second day the news has come out, and you can see that kind of calm has been restored from a broader market sentiment. However, the Facebook shares continue to actually edge a little bit lower. But the overall broader market kind of looked beyond that. And so it's quite interesting to see the kind of more global-minded macro traders comparative to the speculators comparative to the actual stock pickers who are trading the individual company itself. All right, another headline to have a look at, and if I just quickly show you the price of oil. Oil saw a really nice move yesterday. This is what it looked like on the charts. So we were rising all the way from when Europe came into the market. We were trading around 62.40. We got all the way up to 64. So on a single day move, that's a really nice percentage gain. Now there wasn't one specific headline, but from a fundamental point of view, and again I'll leave Sam with the technicals, but there have been a couple of developments, and one you would have seen was that President Trump was hosting Saudi Arabia's Crown Prince, Mohammed bin Salman, or MBS as he's often referred to. And this has increased, as this headline would suggest, US-Saudi talks raise the risk of Iranian crude curbs. So what they're getting at here is, it's summarized a bit later in the article, but if Trump decides to exit the existing deal under which international measures were removed on Iran in return for curbing its nuclear program, it would likely be welcomed by Saudi Arabia, who basically suggests that Iran has benefited from the deal that's been put in place. So essentially the West conceded a little bit and said, okay, we'll stop the sanctionings to the levels that we were doing in years gone by if you curb your nuclear program. If this gets removed, sanctions go back in place, and actually that could drag down Iran's oil exports by about 250 to 500,000 barrels per day by the end of this year. And obviously this fits then the narrative that Saudi Arabia are trying to push, which is of course the high compliance of the existing OPEC and non-OPEC production cuts that are happening globally. Now Iran is absolutely pivotal in this equation, because other than the likes of Saudi and Russia, the big players, the next two on the ladder, if you like, of the OPEC 14 would be Iraq and Iran. And so Iran, just from the top of my head, approximately pumping about 4.5 million a day. A 500,000 decrease certainly helps out in Saudi Arabia achieving its objective in terms of keeping the price of oil elevated in that sense. So these kinds of conversations that were happening in meetings with Trump and Saudi yesterday were the main focal point, as I said, from a fundamental perspective, and that helped the price of oil just continuing to edge higher. The other thing that we've had is, of course, the API crude oil inventories. They came out last night, so let me just show you the numbers here. We had a surprise drawdown, 2.739 million. Expectations were for a build of 3.25 million. So quite a big surprise. A fairly sizable draw against the expectation, and so again, if you look at the price of oil from what would be 8:30, remember, because of the time difference at the moment, so 8:30, that candlestick, quite an aggressive move that was seen, close to retesting up toward the high that was seen yesterday afternoon. And the main thing is we've held on to a bulk of that price movement from yesterday. Hasn't really paired much, and so Definitely be keeping an eye on the kind of Asia Pac lows, or the lows we printed earlier this morning, and then the pivot could be quite interesting level as well at that 63.28, given that was the pullback after initial test of 64 yesterday. The other numbers, I've put them in the chat room already. We had a Cushing build of 1.644 million, so don't forget this does take away a little bit the bullishness of this overall headline, because this is a bearish factor. Gasoline though was a draw, as was distillates. As ever, make sure as well you're listening out for the US output number, which of course has been tracking ever higher and higher more recently. Okay, one other headline before we get into the Fed discussion, and this is something which seemingly is not going away anytime soon, because the US politicians continue to kick the can down the road. Now, not a lot of people are talking about this because of the focus on the Fed in the interim period, but at the end of the week, this probably will catch a few headlines, because government current funding in the US ends on Friday. And this is when, of course, they're looking to put into place a new stopgap, which they have done already on 2 prior occasions most recently. And obviously they're looking to avert a government shutdown for potentially a 3rd time. So, yeah, news to be monitored. Congressional Republicans essentially missed another target to unveil a $1.3 trillion spending bill. And so the House and Senate still need to get their act together, the lawmakers, to pass a bill before the end of the week. All right, talking about the Fed then, we're going to obviously look at this in a lot more greater detail later this evening. And once again, another reminder, it's usually at 7 and 7:30 in terms of the release, the projections, and then the press conference. But because of our clocks not changing until this weekend, remember the Fed decision is at 6 with the press conference at 6:30. So just to make that evidently clear. So what to look out for in the Fed meeting. So this is what everyone's talking about. And this really is an interest rate hike, a done deal. I think we can conclude that if we're looking at the CME federal funds futures, i.e. what the market is pricing. As you can see from this graphic, there is a 94.4% probability of a 25 basis point increase today. This is what the Fed have communicated in their speeches, and also in the projections which were unveiled last time in December. So the interest rate hike is going to happen. That's not what's going to move the market. And so much was a similar theme to many central banks and decisions that we've seen really defining 2017. It's this idea, do you get a dovish hike, or do they go for something a little bit more hawkish, i.e. optimistic about economic conditions, and therefore a meaningful upgrade in the dot plot projections, i.e. rate trajectory over the period going forward. So looking at what the Fed might do here, the Fed in December predicted GDP growth of 2.5% this year and 2.1% next. There are some people are expecting these to be upgraded, i.e. the whole economic assessment from Federal Reserve members likely to reflect improvements. The big change since then is the arrival, of course, of full details of the GOP's $1.5 trillion tax cut, plus a congressional deal to lift caps on federal discretionary spending for the next couple of years. So does this help bolster this idea that economic growth in the US is going to continue at a pace for the time being? The key thing then, what we're looking out for, is alongside the actual rate hike, you're also going to get the statement. So let's look at the statement first. I've managed to snap this out of Goldman Sachs. This is Jan Hasius, who's their chief economist, and what he's done in his research report is basically done a prediction of what he thinks the statement will be. And as you can see, he's struck out with a line through certain words the removal and then bold the addition of the statement. So as you can see, overall the actual statement is largely unchanged. There really isn't much here at all. So confirmation of the hike, and then the one area which possibly would be an addition, housing activity slowed somewhat, possibly reflecting the impact of higher mortgage rates. So that's just because the housing market generally has been very strong, post-recovery from financial crisis. However, it has just come off the boil slightly more recently. So again, the statement's not really going to offer us that much. What is going to offer us the most information, and as a net result then the most market reaction, is going to be this. Then this of course is the dot plots, each yellow dot defining one of the members of the Fed. And this is looking at what it was in terms of the shape of interest rates over the time going forward through 18, 2019, 2020 in the long run, where interest rates will be at the end of each subsequent year. So as you can see, as time goes on from left to right, interest rates in the US are anticipated to rise gradually before then kind of peaking in 2020 and then edging slightly back down in the longer run. Now what's key here is that there's quite a few people which have wondered whether the Fed, as soon as today's meeting, might change this 3 rate hike communication on a median dot plot basis, might move up to 4. Now I would say that's an outside probability. If that does happen, and there's an immediate headline on Bloomberg identifying that in 2018 they are now priced in for, or it's now expected for 4, not 3 rate hikes, that would be ultra hawkish. You'd be looking for equity markets to move lower, i.e. a quicker removal of accommodative monetary policy, so a speed up of rate normalization. You'd be looking for immediate dollar strength in that respect. Yields would spike higher, so treasuries lower, and gold would also spike lower in that situation. I don't think that's going to happen, and that is what most of Wall Street is also thinking. But what we are looking for is potentially a slight upgrade, not enough to translate into 4 hikes. 2019 is where a little bit more of the action might come, and actually there's a lot of this Trump proposals start to be implemented, whether it be fiscal spending, the inaction of the corporate tax cut, so on and so forth, and the economy starts to pick up again, then it's 2019 which might see actually the most movement on the upside. So really it's going to be tracking how much of a change is there at this point amongst the consensus feeling of the Federal Reserve members. What's probably capped this view about how hawkish they can be are a couple of things. Inflation obviously is key, and if you think about inflation in the US, the wage data was a little bit disappointing after it kind of blew markets' minds for a short-term sell-off on the 5th of February. Since then, the wage data we had in payrolls in the last report was not so aggressive to continue that thinking that wages have really taken off, and then followed up with CPI data, which also, in terms of actual inflation, was basically static, as it has been for several months. It hasn't really shown a meaningful move to the upside. So has that restricted the Fed's ability to sound, super hawkish? In addition to this, obviously Trump is getting ever more vocal in regards to trade, whether that be international trade on the tariffs that we've heard with Canada and Mexico, but also with the ongoing NAFTA deal and so on and so forth. So there are some considerations that might restrict the Fed from being too overtly optimistic in that sense. The one thing for sure that we've always seen from the Fed is whenever they hike interest rates, they usually sound fairly dovish. That certainly was Janet Yellen's strategy, because therefore what she allowed herself room to do to manage market psychology was that she managed to actually get in a sequence of multiple rate hikes without destabilizing the market too much, by emphasizing the fact that she'll continue to be fairly cautious and this is a very gradual process. Any disruption to that in a more aggressive tone from Powell today could shake things up and become very much more volatile for market reaction. The other thing, of course, we get the first ever press conference with Jerome Powell. Now, he's already given his testimony to the House and the Senate. He kind of handled that absolutely fine. He is an experienced chap. I wouldn't exactly be looking for mistakes from him today. However, the one questions that I've read this morning, a lot of analysts are looking at, is he going to change the frequency of press conferences held by the Fed, because he has said more recently that he's a supporter of being more transparent to the market. If you think about it, it's the ECB who are probably the most transparent in their structure of communicating to markets, because they have a press conference with every single interest rate announcement, whereas the Bank of England and the Federal Reserve, who have 8 meetings a year, only do it on the 4 times a year. So will he announce a change to that process going forward? Could also be something else to look out for. All right, quick look ahead then for the calendar. So we'll talk Fed much later on this afternoon. This morning, I want to draw your attention to the UK markets again. We had, of course, UK inflation yesterday, and that dropped down to the lower bound of what analysts were expecting. It came in at 2.7%. We're now at the lowest rate we've been since July of 27. So the Bank of England, in their belief, which they've held for several months, that actually inflationary conditions are peaking and will go back to target gradually over the 2-year horizon, has kind of held true in that respect. We have seen a decrease for the first time in several months. Now, what's going to be interesting is that if inflation conditions start to edge lower, what the markets are also anticipating is that the wage data actually also improves today. So if you think about it, we're getting this divergence between the cost of goods to purchase and wages, which has been getting further and further apart, should converge today, which is a net positive for the pound in that situation, at least from an economics point of view. Now, the expectation for the wage data is 2.6. You can see we've not been 2.6 at all for the past 12 readings at all. The last time we were up that high, you've got to go back to kind of early part of 2017. So it's going to be interesting to see how that comes out. That's coming out obviously at 9:30. That'll be something definitely that pound watchers, FX traders, you'll need to watch. Other than that, from this afternoon, existing home sales, I wouldn't be expecting any market reaction there. And then you've got the oil inventories, which, as we discussed, you're looking at the APIs as your benchmark from what to expect. But overall, I would say just keep things relatively tight this morning. You want plenty of ammunition to be able to trade the aftermath of the Fed meeting, which again is going to be 6 o'clock. You're going to get the interest rate announcement, the statement, and importantly the projections. So that first 5-minute period from 6 to 6:05 is going to be incredibly volatile. But then usually it only takes a couple of minutes. The market starts to come to a collective assessment that this projections on GDP, inflation, unemployment, and the median dot plot for interest rates is either neutral, hawkish, or dovish. You then typically see a bit of a move for 10-15 minutes. The market dies down in activity. The press conference begins. You then get another pickup in movement, and then the latter questions are usually it's all wrapped up within the first half an hour or so. All right, let me hand you over to Sam quickly then, and I wish you all a good day, and I'll see you in the chat room. Thanks.
Good morning, guys. Just having a quick look over at the FTSE. Actually, it's just caught my eye as the pound just pushing on. Yep, we do have the data out in 35, so just to be aware. But with the pound pushing higher against most other pairs this morning, we've got the FTSE just coming down, testing the low of the day as we speak, or just having a tiny bounce in the last couple of seconds, which has been, the lowest for quite some time. Actually, if we take this FTSE back onto a longer time frame, you can see, other than obviously where we came down in February, it's the lowest sort of we've been quite some time. Levels again not seen since December 2016. So keep an eye on that. Measures quite well S1 and the low that we saw at the beginning of the week. So just something to bear in mind. A pullback up towards any of the lows of the day would act as a good sort of resistance point. But of course, with the data coming out of the UK in just over half an hour, probably best to sort of wait and see. And with the pound pushing on, as I mentioned, against most pairs, you would presume at the moment, obviously there's still 30 to go, that the data would perhaps be a bit better than expected. So just bear in mind the price action of the pound. In terms of levels to the upside to be aware of, around the R1, I think will be, well, you'd expect a decent sort of test around there anyway, but we really sort of started the move to the downside yesterday that we saw in the morning. Matches up quite nicely. Above that high of the day, around 141.23 on the futures, to bear in mind before getting Monday's high, which is obviously the highest we've been for a while, up at 46. I would say those are the key areas to be aware of as resistance points. If we were to get a worse than expected reading, or sort of, you know, buy the rumour, sell the fact price action, you would expect a decent pullback around the pivot, which was yesterday evening's high, and you can see how well respected that area has been. Around 140.75 was then the high of this morning, and then support as we broke through on that classic. So an important level for cable there to be aware of. If you do break through, you've got some interesting support near the lows of the Asian session and the low of the day, and from yesterday as well. So it could be quite congested if we were to have a move to the downside. You can see, just making this chart a bit smaller there, just how many previous highs are around that point yesterday there. So we did find some good support back on the 16th, where we had the high came down, double bottom from yesterday, so important area to be aware of, just above 140.38 for the pound. As mentioned, the pound was on the highs against most of the other currency pairs, except really the euro, which had been pushing to the high as well. So just hit, well, pretty much to the tick there. You've got key resistance point that we found in the afternoon yesterday, and first test of that level has acted pretty good as a resistance point. Coming back down, levels to be aware of, I would say the previous high of the day, this sort of area here that we did break through, come back to find support. I would definitely have this marked up on all your charts as a key level of support to the downside. We'd also, you know, get in your sort of trend lines from the lows of yesterday up towards the low this morning. That could match up quite nicely later on as well. Other points of interest to be aware of, all the different lows that we found decent support at this morning. You can see it's been quite technical this morning, the euro, and if we were to later on or whatever get a push down, we just have to make the time frame a bit longer. You can see that that low of yesterday, if it was to break through and really get through what was the original high of the first of the month, then the door could open to the downside. But as with any sort of big sort of day-to-day, if you like, maybe non-farm payrolls or whatever, the morning is always going to be relatively quiet for sort of dollar-related products. I know we do have the UK data in the morning, but just to bear in mind, it might be that if you are looking to trade, that you are trading smaller size than normal, sort of saving your ammunition for later on, if you like. Levels to the upside of the euro, you can see here we had the start of the move to the downside, where sellers really did start to take over. 123.91, 124 on the futures, near the R1 level, and a key area yesterday where we had the bit of dollar strength against the euro and the pound, all sort of happening around the break of these levels. Marks up here. This morning we've had gold and yen pushing higher, albeit over the last sort of 10 minutes just finding a bit of resistance on those highs, and you can see gold just coming off that R1 level there as well. Interestingly, it has actually just broken this recent trend this morning, so I'd be aware of that. And you can see when we did break through, came back and found really good support on the classic of that, so it may well be later on around there 13.13 for gold that we do find a bit of support. But obviously just want to stress again, Fed later on could well be a sort of a quiet range bound morning with, you know, perhaps some unusual price activity as well. But just to bear in mind that for the gold there has broken that trend line. Speaking of broken trend lines, and I'll come back to the yen in a minute, you had oil, and we'll just put it back onto a daily chart here. You can see a really nice break, and let me just remove the pivots to clear everything up and get this trend line on here. So you can see really nice break of that trend yesterday from those highs. The lows that we put on at the beginning of the week and end of last week didn't really get another test, but decent breakthrough there. Obviously $64 just above where we're trading now, and perhaps more importantly the key market level, the high of the 26th, the high of the end of February there, which was a nice double top from the 6th as well. So something to bear in mind, especially with the data later on. Could we get a test of that level, which is quite key to the upside? And you can see the high of the year, 25th of Jan there, 66 65 wouldn't be a million miles away if we were to push on through that there. So just to bear in mind there for oil, lowering down the time frame as possible levels for support. You can see the pivot acts quite well with what was a pullback yesterday. Something to be aware of, a couple levels a bit lower down, but obviously as the data comes out closer to time, we'll have a look at this in a bit more detail. Dollar yen, as mentioned, was pushing, well, the yen was pushing to its highs, so the dollar yen to its lows, and since then, like gold, just had a bit of a bounce, but not a million miles away from coming back to its lows there. You can see once we did break this area of support last night, we did come back to pull it back there for a bit of a classic. Keep an eye on the low. If we do break down, again, a bit of support around here that we found yesterday morning, but S1 marks up quite nicely with what was the low of that morning as well from the Bank of Japan comments that came out. So just bear in mind again there for the dollar yen and gold, just keep an eye on those. With those markets pushing to their highs, obviously the yen to the high and gold to the high, we had equities coming down. You saw the FTSE, but we'll have a quick look over at the US equity markets, which just continue to push lower really since, well, you can see here 8 o'clock since we got in. The pivot breaking in the Nasdaq. We've got quite a lot of noise around yesterday's lows and S1s to be aware of, and it probably would be safer to look for a pullback, perhaps to continue this trend pivot, or yesterday evening sort of lower points offering quite a good level of potential resistance for the Nasdaq there. S&P, you can see as well, has already come back and tested that previous low, and that has acted as good resistance. The Dow, which if out of those three markets perhaps have been sort of less inclined to push lower, has just, I guess, broken away. It's chopping around that pivot level, which was, as you can see, that level we're talking about from late last night in the US. So it could be a bit choppy around here. Breakthrough there, and you can see the key areas of support that we made all yesterday around there. S1 marking up quite nicely, one of those as well. Yesterday's highs for all equity markets can be quite important for the upside, but just to stress again, most likely to be relatively quiet, I would suggest. Sort of taking less risk on trades going forward. You've got 25 minutes until the UK data, so we'll be sure to sort of run down that, put a few charts in, but I will get on trading economics, look at the range for the day, for the day's data, and sort of go from there. Any questions about any of the charts, please do get them in the chat, but if not, I will speak to you in the chat and speak to you closer to the release at 9:30.